Owning a home, long celebrated as part of the American dream, has started to feel more like a financial burden for countless families. In city after city, housing prices have drifted far beyond what local incomes can support, pushed upward by years of speculation and ultra-low interest rates. That chapter, however, has officially closed, and now that the tide is pulling back, we're about to find out who's been overexposed this whole time. Think of this as a coast-to-coast tour through the most fragile corners of the American housing landscape. We're breaking down the 10 U.S. cities that appear to be heading toward the riskiest real estate conditions going into 2026. These aren't just places where price growth is cooling a bit. These markets are flashing multiple warning signs all at once, from inventories ballooning far faster than normal to sales activity falling off a cliff, to homes being priced wildly above their fundamental value. If you bought in one of these cities today, it could easily become a decision you regret financially by the time 2026 rolls around. You might assume the biggest trouble spots are clustered in familiar high-cost areas like California or New York, but the data tells a far broader story. The markets most exposed right now are scattered across the Sunbelt, the Mountain West, and the New South regions that saw explosive, unsustainable growth during the pandemic frenzy. And topping the list is a city that became a magnet for people chasing affordability, a pandemic superstar that's now grappling with a harsh and unavoidable reality check. Before we kick off this trip, go ahead and tap that like button. And if you happen to live in one of these metro areas, drop a comment and tell us what conditions look like from your perspective. Make sure to subscribe and hit the notification bell. You won't want to miss the rest of this breakdown. Number 10. Atlanta, Georgia. We're kicking off our journey in the Southeast, where Atlanta, a city known for its booming growth and constant skyline construction, is hitting the brakes far faster than anyone expected. For years, you could see the momentum everywhere: new developments, endless cranes, and neighborhoods transforming almost overnight. But now, the energy in Hotlanta is fading, and it's fading fast. The situation isn't complicated. Buyers are stepping back, and the number of homes on the market is rising quickly. Recent numbers from Redfin show that the median home price in Atlanta has already slipped by nearly 5% compared to last year, which is a pretty dramatic pivot for a market that had been on fire. Even more telling is how long it's taking homes to sell. The typical property now sits for about 77 days, a huge jump from the 54-day average just a year ago. That shift alone signals a massive power change. Buyers aren't scrambling anymore. They're taking their time, comparing options, and negotiating hard. As a result, many sellers are feeling the pressure. Zillow reports that more than 30% of active listings have already seen at least one price reduction. The bidding wars that once defined the market? They're basically ancient history at this point. And the inventory situation is piling on. Zillow's latest count shows over 5,000 homes currently up for sale, a big supply wave crashing right into shrinking demand. Redfin's analysis even shows home sales dipping by almost 1%, while new listings continue to climb. That imbalance puts Atlanta on unstable footing moving into 2026. But the story isn't only about economics. Climate risk is quietly becoming a major factor. Data from the First Street Foundation assigns Atlanta a significant flood threat, estimating that roughly 12% of homes, nearly 12,000 properties, could face serious flooding within the next 3 decades. On top of that, the city carries a moderate wildfire risk, with about 37,000 homes classified as vulnerable. When you combine high climate exposure with a cooling market, oversupply, and increasingly nervous sellers, the picture gets even more concerning. Atlanta is shifting rapidly toward a strong buyer's market. If you're considering purchasing a home there, it's worth slowing down and taking a serious look at the risks before making a move. Number 9. Charlotte, North Carolina. After a short drive north, we land in Charlotte, a standout city in the New South, and a long-time magnet for banking giants and fast-growing tech employers. For years, the Queen City rode a wave of double-digit home price appreciation, with neighborhoods skyrocketing in value at a pace that seemed unstoppable. But lately, the numbers are painting a very different picture, and it's one that suggests a sizable and uncomfortable correction is now underway. According to Reventure News's 2025 market analysis, Charlotte's home value growth has essentially flatlined. They report that appreciation has plunged to just 0.4%, meaning the surge that once defined this market has mostly evaporated. Their forecast score, a rough measure of future price momentum, sits at a bleak 37 out of 100, firmly categorizing Charlotte as a buyer's market and signaling that more price declines are likely ahead. This slowdown has been building for a long time. Reventure's data shows Mecklenburg County, the core of the Charlotte metro, remains roughly 29% overvalued when compared to long-term economic fundamentals. That imbalance puts sellers in a tough position. Nearly 30% of all listings in the county have already been marked down with at least one price cut, a clear sign that homeowners are struggling to attract offers at yesterday's prices. Loan Pronto's 2025 outlook backs up this shift as well. Their report shows the average time a home spends on the market has climbed to 64 days, up from just 53 days the year before, and that lag is becoming increasingly common. But the most important figure is inventory. They highlight an enormous 27.2% year-over-year increase in available homes, a surge that adds even more downward pressure on prices. The underlying problem? Affordability has taken a beating. The typical monthly mortgage payment in Charlotte has ballooned to around $2,747, which is far beyond what many local residents can realistically afford. Charlotte is a textbook example of a market where housing costs outpaced wages for too long, creating a shaky foundation that's now beginning to crack. In short, the correction is still in its early stages, and this is a market that deserves very cautious attention. If you're watching from Charlotte, share what you're seeing on the ground. Do you think the big banks might step in to stabilize the situation, or is this downturn just getting started? Number 8. Nashville, Tennessee. Next, we swing west into Nashville, the beating heart of country music, a rising tech hub, and, let's be honest, the unofficial capital of bachelorette parties. Over the past 5 years, this city became one of the most sought-after housing markets in the entire country. But that red-hot streak is cooling off rapidly, and the latest numbers should make buyers pause. According to Reventure News, Nashville's home value growth has essentially hit a wall. Year-over-year appreciation has plunged to a microscopic 0.1%, a dramatic fall from the rocket-like trajectory the market enjoyed during the pandemic boom. And if the current data is concerning, the outlook is even worse. Nashville's home price forecast score sits at just 30 out of 100, one of the lowest ratings in the nation, a clear signal that the market may face a steep downturn heading into 2026. Even with prices stagnating, the market remains dangerously inflated. In Trousdale County, which is part of the greater metro area, homes are estimated to be nearly 50% overvalued based on long-term fundamentals. That disconnect is huge. Yet many sellers are still holding on to yesterday's expectations. Reality, however, is catching up with them. In Davidson County, Nashville's core, more than 32% of all listings have already gone through at least one price cut. Redfin's data backs this up. Homes are staying on the market noticeably longer, with median days on market rising to 68 days, compared to 60 days just 1 year ago. That slowdown suggests buyers are becoming far more selective and far less eager to rush into overvalued deals. And just like in Atlanta, the climate risk in Nashville adds another layer of trouble. The First Street Foundation reports that about 14% of homes face significant flood danger. Even more alarming is their projection related to extreme heat. The number of days topping 106 degrees Fahrenheit could surge by an astonishing 185% over the next 3 decades. That kind of climate pressure will inevitably affect insurance costs, long-term livability, and ultimately, yes, housing prices. Nashville is now a textbook example of a market where home prices drifted far beyond what local incomes can reasonably sustain. With falling demand, overvaluation, and escalating climate risks, the road ahead looks rocky. If you're considering buying in Music City, it's worth taking a very careful look before signing anything. Number 7. Tampa, Florida. Break out the sunglasses, because our road trip now takes us deep into Florida, a state that became ground zero for the pandemic-era real estate explosion. Nearly every corner of Florida saw prices soar, but Tampa is now flashing some of the clearest signs that the fire is burning out. According to Zillow's latest numbers, average home values in Tampa have already slipped by about 5.2% year over year heading into late 2025. The correction isn't theoretical, it's actively unfolding, but the real shocker is what's happening with inventory. A recent analysis from Mangrove Bay Realty reveals a 36.3% surge in active listings compared to last year, a massive jump that's reshaping the entire market. One of the most important indicators of housing stability, months of supply, has exploded. Tampa went from an alarmingly tight 1.2 months of inventory in 2023 to roughly 5.6 months by 2025. That swing is enormous. The city has effectively flipped from one of the country's most aggressive sellers' markets to a balanced market, and in many neighborhoods, it has become a clear-cut buyer's market. The bidding wars that once defined the region have basically vanished. There is one bright spot, but it's aimed squarely at investors: the rental market. Average rental yields are sitting around 6.2%, and rents continue to climb. But this creates a troubling contradiction. Tampa is becoming a strong place to own rental property, yet a much riskier place for someone trying to buy a home to actually live in. High rents are being driven largely by people who simply can't afford to purchase, a textbook sign of a housing ecosystem that's unaffordable and fundamentally out of balance for ordinary families. If you're hoping to buy a primary residence in Tampa, you're now facing two big headwinds: declining home prices and heavy competition from investors scooping up properties for rental income. That's a risky combination, especially if you're looking for stability or long-term appreciation. For those of you in Florida, I'd love to hear your perspective. Are you seeing the same patterns in your city? Number 6. Las Vegas, Nevada. Next, we trade the Florida humidity for the dry heat of the Mojave Desert and touch down in Las Vegas, a city famous for taking risks, and unfortunately, its housing market is no exception. Vegas has always been shaped by outside money, tourism-driven booms, and investor activity. And right now, those forces are creating a market that looks increasingly unstable. Zillow's latest projections already point to trouble ahead, estimating that home values in the Las Vegas area will drop by about 1.2% over the next year, and the softening is clearly underway. According to Rice Las Vegas, the number of active listings has jumped nearly 37% since last fall. At the same time, sales are slipping, with activity down 8%, a combination that means more homes are sitting on the market while fewer buyers are stepping up. This imbalance has pushed available inventory from 3.1 months to 4.6 months, signaling a clear move toward a buyer-friendly environment. But the most unsettling part of the Las Vegas story isn't the inventory, or even the price trends, it's the enormous presence of investors. Rice Las Vegas notes that roughly 23% of all home purchases in the area are made by investors. And since the year 2000, they've collectively bought more than 131,000 homes across the valley. That's a staggering share of the market, and it means Vegas is unusually dependent on investor confidence. If these buyers start to worry about falling prices and decide to offload their properties, the city could see a sudden surge of listings that overwhelms demand almost instantly. And remember, all of this is unfolding while the local unemployment rate sits at 5.8% as of June 2025, noticeably higher than the national average. High unemployment paired with declining prices, ballooning inventory, and a heavy concentration of speculative owners creates a recipe for volatility. When you put it all together, Las Vegas becomes exactly what you'd expect: a market built on risk. And right now, it's not a wager you want to make. Don't roll the dice on this one. Number 5. Salt Lake City, Utah. From the desert, we climb into the mountains and arrive in Salt Lake City, another one of the major pandemic boomtowns. This metro exploded in popularity as tech companies expanded and remote workers streamed in, turning the city into a poster child for the work-from-home migration. But now, at this high altitude, the housing market is starting to feel lightheaded, and the shift is happening quickly. BiggerPockets' August 2025 market update puts it plainly. Salt Lake City is now moving into buyer market territory. The reason isn't complicated. Inventory keeps growing, and demand is easing at the exact same time. National forecasts, which Salt Lake City tends to mirror, are calling for a mild price correction, warning that U.S. home values will likely slide into negative territory by the end of the year. Salt Lake isn't far behind that trajectory. There is one stabilizing factor: buyer credit quality. Unlike the instability leading up to 2008, today's borrowers look very different. Median credit scores often land above 750, which helps reduce the risk of widespread defaults. But even with responsible borrowers, Salt Lake City has a major vulnerability. Its entire market is chained to mortgage rates. Affordability has been stretched thinner than ever. The only thing preventing a sharper downturn right now is that rates have dipped into the mid-6% range. It's just enough to keep demand from freezing over. If rates rise again, the market could seize up almost immediately. But even if rates fall, prices would likely just flatten at levels that remain wildly out of reach for most local workers. Either scenario leaves the housing market stuck in an uncomfortable position. Too expensive to sustain long-term growth, yet too rate-dependent to fall naturally. Salt Lake City is balancing on a knife's edge, a market that can't rise but isn't quite willing to drop. The question now is whether it will find its equilibrium or tip over the edge. Number 4. Phoenix, Arizona. As we drop back into the desert, we arrive in Phoenix, a market that isn't heading toward a correction, but is already deep in one. The Valley of the Sun is going through what many analysts are now calling a full-blown market reset, and it's anything but gentle. According to the Zillow Home Value Index, Phoenix home prices are already down 4.6% year-over-year as of September 2025. This isn't a prediction or a warning sign, it's the current reality. Realtor.com even highlighted Phoenix as one of the U.S. metros with the highest share of listings showing price cuts, which signals just how quickly conditions have shifted. Inventory is piling up as well. Zillow counts more than 5,200 homes for sale, while other market trackers put that number closer to 7,600 active listings, depending on how they measure the data. Either way, supply is well above normal. Meanwhile, buyer demand is fading fast. Homes sold or under contract fell by roughly 12% in just a single month earlier this year, a clear sign that buyers are retreating. And sellers? They're rattled. A report from AZ and Associates found that delistings jumped 47% year-over-year across the metro, meaning a huge number of homeowners are choosing to yank their properties off the market rather than accept the lower offers buyers are sending their way. That's textbook gridlock. Sellers refusing to budge and buyers unwilling to overpay. Even big players are backing away. Institutional investors, who once bought aggressively across the Phoenix area, reduced their share of purchases in the first quarter of 2025. When the investors who helped fuel the boom start to retreat, it removes a major support beam from the entire market. Right now, Phoenix isn't in a full-scale crash, but it is in the middle of a sharp rebalancing. With prices falling, inventory high, sellers growing nervous, and investors stepping aside, the power has shifted decisively to buyers. If you're thinking about selling in Phoenix, the road ahead over the next year is likely to be rough. Number 3. Miami, Florida. We've hit the top 3, and to get here, we're jetting back to Florida for what might be the most bubble-prone market of them all. It may surprise you to see Miami this high on the list, but the data is hard to ignore. UBS's 2025 Global Real Estate Bubble Index ranked Miami as the #1 housing bubble in the world. Yes, worldwide. And it's the second year in a row they've given Miami that title. UBS describes a bubble as a long-lasting, major mispricing of homes relative to fundamentals, and Miami is checking those boxes in bold. Just look at price growth. Public radio outlet WLRN reports that the median single-family home price has surged at least 70% since 2019, easily beating the national run-up of around 50%. The local economy hasn't kept pace. With a median household income near $76,000, a typical buyer can comfortably support a mortgage on something close to $300,000. But the median single-family price sits around $660,000. And that's after a recent 1.5% dip. The gap between wages and home prices is enormous. Condominiums look even shakier. Nora Real Estate notes condo inventory up more than 31%, translating to roughly a 14-month supply. For context, 6 months is considered balanced, 14 is a deep buyer's market where sellers lose leverage fast. So, what's propping things up? Cash. A striking 37.1% of transactions in Miami are all cash, more than twice the national rate. That tells you who sets the tone here: global capital and high net worth buyers, not local paychecks. If that inflow cools due to currency moves, geopolitics, tax changes, or simple risk aversion, the air could rush out quickly. Bottom line, Miami is the textbook definition of a high-risk market: eye-watering prices, fundamentals that don't pencil out, swelling condo supply, and heavy reliance on outside money. Move with extreme caution. Number 2. Austin, Texas. Our second-to-last stop brings us to Austin, a city that became the ultimate symbol of pandemic-era migration, tech industry transplants, and pure speculative overload. And if you live there, you already know the correction isn't coming. It's well underway. The numbers are jaw-dropping. According to Reventure app data, Austin home values have fallen 21.5% from their 2022 peak, the single largest price correction of any major metro in the United States. Austin had one of the biggest booms, and now it's experiencing the biggest bust. Oddly enough, that dramatic drop has pushed the market closer to reality. Analysts estimate the metro is now only 5–6% overvalued, a huge improvement compared to the insanity of 2021 and 2022. But don't mistake that for a recovery. The correction isn't finished. The Home Buying Institute expects prices to keep sliding throughout 2025 and likely into early 2026. Their forecast suggests the market may not hit bottom until sometime in the third or fourth quarter of 2026. In other words, Austin might still be more than a year away from finding solid ground. Right now, it's a full-fledged buyer's market. Inventory is heavy, demand is soft, and there simply aren't enough buyers to mop up the available supply. As a result, many homes sit for over 2 months before they finally attract an offer, a dramatic change from the bidding war days of the pandemic. Austin has become a cautionary tale about what happens when hype, speculation, and tech optimism take the wheel instead of fundamentals like income, wages, and sustainable demand. This 2-year decline hasn't reached its conclusion, and trying to buy now is essentially the definition of catching a falling knife. If you purchased a home at the 2022 peak, odds are high you're currently underwater. Unfortunately, that's a painful, sometimes multi-$100,000 lesson in market timing. Number 1. Boise, Idaho. We've finally reached the end of our journey, and the city that ranks as the number 1 riskiest housing market in the United States heading into 2026. Like Austin, Boise became one of the pandemic's breakout stars, a place everyone seemed to be moving to overnight. It turned into the poster child for the great work from home migration out of California, and for a while, it looked like the city could do no wrong. But that gold rush left the local market sitting on very shaky ground. According to Waypoint Idaho's latest market report, Boise is currently in a rebalancing phase. Prices are either flat or slightly higher compared to last year, but that's only because they had already dropped significantly from their pandemic peak. The biggest warning sign isn't prices, though. It's inventory. House Canary's data shows that Boise now has more homes on the market than at any point since early 2020, before the pandemic housing boom even began. This surge in listings combined with sluggish sales is steadily transforming Boise into a buyer's market. The core issue is affordability, or more accurately, the lack of it. Prices skyrocketed so quickly during the boom that they became completely detached from local incomes. Boise is now dealing with one of the worst affordability gaps in the entire country. On top of that, the metro area is flooded with new construction. Builders overproduce during the frenzy and are struggling to unload their inventory. Many are offering aggressive incentives just to get homes off their books rate buydowns, closing cost credits, upgrades, you name it. This adds to the city's growing shadow inventory. Finished homes that haven't sold yet. That backlog puts even more downward pressure on resale values. While markets like Austin are deep into their correction, Boise is only beginning its downturn, and that's exactly why it tops this list. Boise has every ingredient for a B, drawn-out decline: steep overvaluation from pandemic highs, an oversupply of new builds, and local wages that simply cannot justify current prices. The celebration is long over. Now comes the cleanup phase, and it may take years before this market finds its footing again. It's the ultimate pandemic boomtown hangover. If you agree with Boise taking the #1 spot, let us know in the comments. From Atlanta to Boise, the theme is the same. Home prices drifted too far away from local incomes, and now the correction is arriving with force. If this cross-country road trip gave you some useful insight, be sure to hit that like button and share it with anyone thinking about buying or selling. Don't forget to subscribe for more deep dive coverage of the U.S. economy, and tell us which city you want us to break down next. Thanks for watching. Stay informed and stay safe.